Good morning, good afternoon, good evening, no matter where you are joining us from. Welcome to our third of our Business and AI faculty lecture series. I am thrilled to be joined today by Dr. Zach Feinstein, who's an associate professor at Stevens Institute of Technology School of Business. Dr. Feinstein, thank you so much for being here with us today. It's going to be a pleasure, and you're going to be teaching me today about a topic that I have no clue about. So I am seriously looking forward to this conversation today. Dr. Zach Feinstein received his bachelor's degree from Washington University in St. Louis in systems science and financial engineering. And he received his master's and PhD from Princeton University in operations research and financial engineering. Dr. Zach Feinstein, thank you so much again for being here with us today. This is the third of our faculty lecture series in Business and AI, and I cannot tell you the feedback that we have been receiving for this lecture series. Incredibly exciting things to learn from all of our professors. And today you're going to be talking about AI in finance, rewiring robo-advising for the autonomous portfolio. So with that, I hand it over to you. And thank you so much again for being here with us today and for teaching us something new today.
Thank you very much for that introduction. Thank you, everyone, for making the time to come in today. As was mentioned, I'm going to be talking about robo-advising, where it sits and where it's potentially going now with the advancements in AI that we've seen over the last couple of years. So as kind of an outline, I'm going to follow what I consider kind of a four-act structure here. First, with the introduction to robo-advising, we're going to say where the industry sits, what exists currently, and what it is doing. Then we're going to look at kind of the forefront of where things are going. So not just the advising part, but also the background engine that could be running these systems. And then really pushing further in the AI and saying, what if we go beyond the robo-advisor to look at autonomous agents? And then we'll conclude our lecture today by looking at some open problems and where the research is currently sitting to see where this whole field is going. So to get right in, what is robo-advising? So fundamentally, a robo-advisor is just any digital platform that provides an automated, algorithm-driven financial planning service where there's very minimal human supervision. So what we mean by that is a app, a website, anything that you can sign into that is doing what is traditional financial planning, traditional wealth management that you'd have to pay significant amounts for, but now done at scale. So it democratizes, it lowers the barrier to entry, and at the same time, it automates. It lowers these barriers to entry because it's doing something at scale in repetitive, automated ways. So portfolio rebalancing, tax loss harvesting, dividend reinvestment, all of this is being done in the background across a wide range of smaller portfolios rather than the traditional wealth management, which is done for individuals with large portfolios on their own. So when we're talking about robo-advisors and when we're talking about kind of wealth management more generally, in the background sits things like modern portfolio theory. So whenever you hear terms like the risk-return trade-offs, ultimately, this is all based on modern portfolio theory that says for higher return, you need to accept a higher risk. So in the background, a lot of what robo-advisors are doing is trying to understand where do you sit on this risk-return trade-off? How much risk aversion do you have? And once we know that, we can then optimize a portfolio for you. So rather than this being done by professionals, by individuals, by humans, a robo-advisor is doing this simply by the mathematics. So the result of this experience is one in which you, the user, provides your goals, you answer a questionnaire, and then the robot, the robo, is handling the math. So there's no human in the background. There's just the computer in the background. So when we look at who's leading in robo-advising, there's two dominant platforms. There's Betterment and there's Wealthfront. So these are both tens of billions of dollars of assets under management. But even when we think about the scale of the financial industry, when we look at Vanguard or BlackRock, instead of being tens of billions of dollars of assets under management, those are tens of trillions of dollars of assets under management. So while there's scale here, these are by no means small numbers. They're not up to what people have discussed when they really are thinking about what robo-advising could be. And if we look at what these firms are actually doing, they're really solving the onboarding problem. They've made it really simple for a user to invest. They've automated access to the markets, but they haven't really done much beyond that. And we'll go through a little bit of what that means. And essentially, what they've done is an interface. So you work with a robot, you work with the app, and it tells you what portfolio you're going to have. But in the background is still the traditional financial intermediation. So maybe it tells you should have 60% in equity, 40% in fixed income, and then maybe once a month, once a quarter, as your portfolio naturally will drift because asset prices change over time, they'll periodically rebalance. This is not done on a continuous basis. You're not going to have on every single day, day to day, sticking at that 60-40 portfolio. So you'll have asset drift. You're not going to exactly match what you have, what you're being told your desired portfolio is. In addition, we have settlement delays. So while we're used to thinking about financial markets as saying, when I hit buy on Robinhood, I own that asset at that moment. In reality, I don't actually own that asset until 1 day later. This is what's called T+1 settlement. And this creates certain bottlenecks. If you think back to the GameStop episode where Robinhood had to stop allowing people to buy GameStop stock, the purported reason that they gave was the margin requirements on this kind of T+1 settlement, because essentially there is counterparty risk during that time period. If you said you're buying and then you step away and you just refuse to actually pay, that is a risk to your counterparty. So there's margin requirements, there's cash that you need to put up front to handle these risks. So sitting in the background, if everyone's performing the exact same position, there's these margin requirements that are going to be put in place because of these settlement delays. So in some sense, the platform, the interface is modern, it's AI governed, it's really sleek, but the back end is really just 1970s technology. We haven't really updated what the back end system really looks like. Furthermore, when you're actually using one of these robo-advisors, they give you a questionnaire. And that questionnaire is to determine, as I said, your risk aversion. So ask questions that try to get to how risk-seeking or risk-averse you are. Do you want high returns, high risk, or do you want just steady returns, but you know you're going to be safe? And this works pretty well. The problem is, unless you go in and manually review this, you're going to be stuck at that static position no matter what else happens. So if the market changes, if your life changes, if all of a sudden you're going to be having a child, so maybe you want to go for a safer portfolio, you have to manually know to go to the system, re-answer those questions in order to get your new portfolio. So this is a very slow process. It's a very coarse solution. People don't necessarily think about this too frequently. If you think to the bespoke wealth managers who you have to pay hundreds of thousands of dollars to get, for them, they'll be checking in with you regularly to see what's going on in your life. So one of the questions that we're going to look at later is, can we use AI in this way? So kind of overview of where the system is, we solved with Wealthfront and Betterment access and onboarding, but not the decision-making and not the execution. In the background, you still have humans that are executing your portfolio. So they do not provide continuous portfolio management that adapts in real time. All they're doing is really solving that access problem. So the question that we're going to ask in this lecture for the 30 minutes or so that we have remaining is that if the market is actually a 24/7 system, why do you want your portfolio to be managed in very infrequent, discrete, disconnected events? So getting into the actual kind of forefront of where things are going, we want to reframe the problem. So traditionally, when we talk about robo-advisors, the question we ask is, what assets should Alice hold today? And this is really kind of the modern portfolio theory question is, we have the risk aversion, so what assets should we be holding? What should our portfolio be? We never really ask the follow-up question of how do we actually maintain that exposure over time? So we want to move a static position into a dynamic process. We want to say, rather than once every quarter, the advisors, the humans sitting behind the scenes are going to rebalance the portfolio to put it in line with the positions that you want. Instead, we want a system that does this automatically in a more continuous fashion. And kind of the building block to do this is with ETFs. So these are exchange-traded funds, which are constructed most of the time to track sector indices. And really, these are market cap weighted positions. The reason market cap weighted works so well with exchange-traded funds is the fact that as the underlying asset values change, the market cap weights stay constant. If Apple stock goes up relative to everything else in the market, its market cap is also going up. So you don't need to do these rebalancing. This is why market cap weighted is really nice. But when you think about your own portfolio, if you wanted 60% equity, 40% fixed income, you don't want that to be market cap. You want a target weighted position. And ETFs, while there are some target allocation ETFs, they're much smaller and they have much higher fees, management fees associated with them. So we can kind of think that ETFs are great for broad diversification. You can get sector or market level diversification, but it doesn't help you for your individual portfolio. You still need to be rebalancing quarterly or at some schedule because of the drift in the weights over time. So now we want to ask, how can we do this? How can we design a ETF that actually maintains target weights? And we're actually taking an idea from decentralized finance to do this. So traditional markets follow what's called an order book. This is a continuous double auction where if you want to buy, you can either take a market order. So you say, I'm going to buy at the market, or you can place a limit order. So you say, I want to buy at this price, and you just wait for someone to match with you. So if someone matches with you at the price that you set, then it succeeds and it executes. Otherwise, you wait in the order book until that occurs or until you cancel your order. AMMs, automated market makers, are a fundamentally different paradigm. They quote prices and execute trades just based on a mathematical formula. There's no individualized, I'm going to quote a specific price and I want to execute there. Instead, it's just some mathematical formula that everyone in this market, every liquidity provider in this market is subject to. And this is fundamentally a novation idea. Every buyer goes to the AMM. Every seller goes to the AMM. It sits in the middle of every transaction. This is where it was very useful from kind of the decentralized finance world because it's really working in this scheme where maybe I don't know my counterparties and I don't necessarily trust them. So now there's someone sitting in the middle that's able to handle that. And the way that this works, the way that it's actually able to execute trades is by holding a basket of assets in the background. This is sometimes called the liquidity pool, and the quoted prices and the actual execution is just dependent on the size of the positions in the liquidity pool. So if that AMM holds $1,000 worth of S&P 500 and $500 of some fixed income ETF, it just knows those numbers. It doesn't need to know anything else about the market. So then trades are executed along what's called a utility invariant curve. So for instance, we can use a logarithmic curve where we take Wx log x plus Wy log y, where x and y are the number of shares you have in these two assets. And we can do more than two assets. Two is just nice because we'll be able to visualize it on the next slides. But fundamentally, the idea here is that we're going to take a utility function like this, and we can map it into actual portfolio logic. So if we follow this Wx log x plus Wy log y, what we're actually targeting here is a Wx weight in x and a Wy weight in y. So we get this target weighted position that we want. And the reason that it does this rebalancing is through the actual constant function structure. So we have our utility indifference curve. So we have kind of this picture. And let's say our initial reserves are we have half a unit of x and 2 units of y. And as we do this, we then can allow people to execute against it. So if someone wants to come in and sell delta x units in exchange for delta y units, they give delta x to the market. So the utility shifts to the right by delta x, but then shifts down because delta y are being given to this trader. So we move along this invariant curve so that we do not shift off of it. So we don't need to know anything about what is X, what is Y, what are these assets, what is an external market trading them at. We just need to know what our curve is and the size of the positions that people want to trade. This is the key aspect of how AMMs work. But you're not necessarily doing this for free. If you're one of those liquidity providers, you collect a fee on a fraction of those incoming assets. So when that delta X is going out in, a small fraction is also being paid out to anyone that provided the liquidity, the X and the Y sitting in the background. And if we take a marginal size trade, we just do differentials, we're able to get a quoted price. So this would be kind of your quoted mid price of this market. And this is where the rebalancing really works. Because if I look at an AMM and say, oh, the relative price of these assets is 2, while the external market says the relative price of them is 1.5, I'll want to rebalance them. I can arbitrage between these two markets. I can buy from the external market and sell it to the AMM, and in so doing, match the price between these two markets. And that's really the key here. When we look at this invariant curve, if we say, well, we have target weights, the real idea is, can we set those the invariant so that our target weights are so that our reserves match the external market pricing. And when someone wants to deposit assets or withdraw assets, all we're doing is shifting this curve up or down at a constant price. So you're essentially buying into a portfolio or withdrawing a portfolio. So when we think about this, as I've been mentioning, the AMM, we are not really thinking about it as a market maker, which is the traditional decentralized finance way of looking at these. We're looking at this as a continuous rebalancing engine. So traditionally, you have to continuously trade if you want to stay at your target weights. There's just that natural drift that occurs. In the AMM, because you're essentially offering an arbitrage anytime the weights are mismanaged, there's counterparties who are willing to enforce the weight for you. So while this often seems like you're losing money by doing it, you're offering an arbitrage to someone else. In practice, because of the small fees that can be charged for this, and because when you're actually implementing trades manually, there's cost to that, it actually generally cancels out and matches up quite nicely. So traditionally, we're rebalancing at set time intervals. So for instance, quarterly, while the AMM-based system, if it were to be implemented, is rebalancing with every single transaction. So the idea is that we can guarantee that the market incentives are pushing our portfolio towards what we want at every single time point. So this is a coded pricing engine. This it doesn't even require AI. We've done this with a deterministic system. The idea is, yes, AI helps us come up with our desired portfolio, and we're going to get further into that in the next slides. But in the background, the engine that can make this all run does not need to be AI. We don't need agents that can hit buy and sell for us. We can use this kind of AMM system in order to actually do the rebalancing that we want to implement. And because we can do this without having to have some human in the background who's hitting buy and sell and making sure you stay in balance, that's really a bottleneck to these systems. So if I was trying to rebalance a million different positions, I'd be completely overwhelmed. It would not be possible to do this. What's nice about the AMMs is we now have an automated system that can do this rebalancing for us. We don't need a human sitting in the background. We have other humans who are just taking advantage of us, who are re-executing this trade for us. So now instead of having to recommend, like if when I last looked, it's kind of 10 predefined portfolios that Betterment would recommend to me. It say, oh, you're more risk averse, so we're going to give you this position. And if you answer the question slightly different, it's a slightly different position, but it's really only 10 different predefined portfolios. That allows them to have the scale, to not need to worry about each individual position. But now we have something that actually could scale. We don't need to manually update these positions over time. So now instead of buying a prepackaged product, we can run personalized processes, which means we can start thinking about our weights not just as I answered a questionnaire sometime historically and I have to wait until I decide to go back in to do it, is I can say my weights are now some function of market state, which is taking, for instance, my risk aversion into account, but also what's happening in my life. So if I'm having a child, that's going to change how I want to be invested. So we can take these kind of life events, the investor state, into account in order to really think about how our portfolio should be personalized. So the portfolio becomes a rule that the system enforces rather than just being a product that I'm buying. And once we go in this way, we really want to think about, we're not just advising, we're now becoming an agent. So the AMM sits in the background as kind of this engine that allows us to execute a desired portfolio. But we still need our driver. We still need to know what position we want to hold. So we need to determine what that strategy should be for each individual. And really the idea, as I've kind of mentioned, is instead of just waiting for manual review from the customer, for instance, going in every January 1st and re-looking at their position and saying, yeah, this looks good or this doesn't look good. Instead, we want something that can actually continuously update as the customer evolves, as the customer's world changes, not just as the market changes. So this operates within some predefined constraints. We don't want an AI agent that can do anything, that can hallucinate what's happening in your life by just saying, oh, you turned 30, so obviously these events are now happening, is not something we want. We still want to put strict constraints on what the agent can do. So we can still set it to put risk limits, to have specified asset classes. But for instance, maybe we say instead of targeting that 60-40 portfolio, we might say, well, we want to target something between a 50-50 and a 70-30. And depending on what's happening in the market, depending on what's happening in my life, to just evolve through that space appropriately and not have to say, well, right now I want 50-50, and then in 3 months, I have to go in and tell it, please update to 60-40. We want the system to be able to do this automatically, to be able to see what's going on in my life and update accordingly. So instead of answering that short questionnaire in order to know what your risk aversion is, we can replace this with an agent that does continuous inference. So it can keep track of market conditions. So looking at volatility, it can look at kind of news events. It can look at macro trends. It can really start to look at what's actually happening in the market, as well as your individual behavior. So as I've been mentioning, just using as an example throughout, if all of a sudden you start, and we've seen this with marketing, you start buying diapers, then Target will start sending you ads for other baby products. But we can use that same information to say, if you're buying diapers, you're likely have a child, which means that your expenses are going to very drastically change compared to prior to that event. So we want a system that can take this information and really use it to help create your portfolio rule that can help determine how you should be invested, not just waiting for you to tell it, change how I'm invested. So the agent is adjusting your target exposures as your market condition and investor state change. So if we think about this, advisors suggest changes, and then the human has to act. This is how financial advisors have traditionally worked. This is how robo-advisors have traditionally worked. What we're really proposing here is that the agents can act autonomously in a continuous control. We don't need to wait for someone to act. We can start actually using the data that we already have in order to improve the system automatically. We're not just providing better advice, we're eliminating frictions between change of state, decision, and action. That's really the goal that we have with robo-advising. That's really the promise that was made when people started talking about robo-advising years ago, was really the idea of you don't need to hire an advisor. The machine, the AI, the machine learning, automatically knows what you should be doing and handles it for you. So really, we can now start to actually go towards that promise by using AI agents. But again, one of the key reasons that this is possible is the fact that we have this engine in the background that can allow us to actually do the rebalancing on a personalized scale rather than doing it manually, which would not permit that. That would still require us to have those large pools of single positions, because large pools of single positions are really hard to maintain, or easy to maintain. Individualized positions are hard to maintain. So this is really the idea. This is where we want to go. This is how we're kind of pushing that envelope. So if we really think about how the system functions, we have a pipeline from the user into a market action. So the agent is continuously monitoring liquidity needs, risk sentiment, what the investor is doing, what's going on in their life. And then it updates the weights based on the portfolio rule that we've outlined, this function F on the market state and on the investor state. So the agent could also update even if your life, your investor state hasn't changed at all. But if the market has changed, for instance, we saw that quite a bit has happened in reality through just macro events. The war with Iran has drastically changed oil prices, potentially going forward. So this has nothing to do with the investor state, but it does have to do with the market state. And then the execution is just by moving the portfolio weights in the AMM engine. So we're just changing what incentives we're giving for external actors to update our portfolio. So it's really a continuous feedback loop between the investor state, the decision making by the AI, and the execution by the AMM engine. This is really what we're looking to create here. This is kind of the promise of robo-advising that we're looking to work towards. But there's some pieces that are still needed to make this possible. For this execution flow to actually function, for an AI agent to be able to execute these changes in weights, we need everything to be programmatically accessible. We need digital markets. We need digital assets. This is where tokenization becomes important. So many of you may have heard the term tokenization before, where it's kind of the idea of we're going to put real world assets onto the blockchain. That's nice, but really the value of that, of tokenization, is having digitally native assets that now an AI agent can actually work with. If we needed to, at some level, have a human involved in the loop, then the AI agent is ultimately just prodding the human, and we get back to those bottlenecks, to the manual bottlenecks that exist. So to really have a truly autonomous system, we need digitally native assets. And then the agent needs to be able to have access to an API or to a smart contract. We don't want it to be calling up a broker in order to place a transaction. So ultimately, this architecture allows us to directly translate market actions without having a delay. That's really the idea. Once it's tokenized, then we move beyond that T+1 settlement. We get into T+0 settlement of tokenized blockchain. So it gets rid of some of these margin requirements that cause some issues, for instance, with the GameStop experience. So we really start to see where this all becomes one big system that we need to work with, rather than thinking about this as one interface where robo-advising is just this interface to the traditional market. We might need to look beyond that and look towards future financial systems to make this plausible. So with the time remaining to me, I want to just kind of push further on what are the open problems here. This was very kind of looking towards the future of where things are. Again, robo-advisors exist, but they're not doing what I proposed. And the reason for that is the open questions that we're working on here at Stevens. So one current problem is that the current AMM designs were built for static strategies. But what we've been looking at with our autonomous agent is a system that actually changes the weights over time. We don't want that static strategy that needs to be updated once a year. We want something that can continuously be updated based on market events and investor state. But if we do this naively, we end up introducing more excessive market incentives for the counterparties to our AMM. And that means we're basically giving up money for no real reason. We're creating excess losses for the investor. So what we've been working on here at Stevens is designing new classes of dynamic weight AMMs that minimize this cost of continuous rebalancing, so that as we change these positions over time, we're not actually giving up excess money, excess investments to these arbitrageurs, to these counterparties, when we want to figure out how we can do this more efficiently. But beyond that, one thing that I kind of talked about is that, well, we can scale. That because we have these automated systems for rebalancing, this can scale much better. And this is just something that we are conjecturing. We don't actually know that this can scale across millions of different portfolios. And really the question is whether there is whether there's enough incentive for, let's say, a position with $10,000 in it. Is there someone that's willing to actually act as a counterparty and extract the profits from that small pool? So do we end up with a system that collapses when we actually have these different small pools of liquidity, rather than the traditional AMMs in decentralized finance that have millions of dollars invested in each one that are just pooled together? So again, are we going to end up with something where we ultimately are replicating those 10 portfolios that the robo-advisors currently have, or can we get something that actually works on an individualized basis? So we need to actually understand the coordination or the failure of this coordination when we work at scale. So that's kind of that second problem. And then once we add in the AI agent, we need to actually ask, can it model the customer's true financial desires? Because maybe I have decided that I'm just going to this year spend a lot of money and take a lot of really nice trips, which might look like I have a lot of liquidity needs and I'm going to be a profligate spender here on out. But maybe that's not actually true. And if I could talk to to a human, I could explain why I'm doing this out of character behavior. But the even bigger problem is once we have an AI agent, could it start hallucinating my risk tolerance? Could it just think all of a sudden my risk tolerance has gotten much higher, that I want a much riskier position just based on some hallucinated belief? So we really want to ask, can we build these agents to satisfy a fiduciary standard? Can they be explainable? Can the agent actually explain why it updated my position over time? Was it for any particular reason, or did it just hallucinate some desire that I have, or did it hallucinate a did it hallucinate the market state? Did it all of a sudden think that that what was said on Twitter is actually true? So these kinds of risks exist. So we need this fiduciary duty, we need this explainability, and we also need to be able to hard code limits into what the AI can and cannot do. So we need to be able to say, no matter what's happening in the world, do not allow me to purchase Bitcoin, for instance. Maybe I just do not believe in cryptocurrencies. Do not implement that at all. This is hard coded. The AI cannot override it no matter what happens in the system. So really we need to ask, how does this AI agent work? Can it act in a trusted manner that I actually can put my money behind it? So kind of in summary, we have the components, we know the components that we need for this truly autonomous financial system. We have our engine, which is the automated market makers, which allow for our continuous execution and rebalancing. We have our driver, which is the AI agents that can do this dynamic decision making. But we don't yet have the reliable and stable system. We still need to know how these AMMs will actually work when we want a dynamic strategy. We still need to understand if this can actually scale when we move from large positions to individualized portfolios to really get that democratized promise of robo-advising. And then on the AI front, we need to know, can it be reliable? Can it be trusted? How do we actually satisfy fiduciary standards? And can we do that without risk of hallucination? So while the architecture is clear, the component robustness remains the open question. And what we're doing here at Stevens, we have the Craft Center. So this is the first NSF-backed center specifically devoted to financial technology. And the goal is really to bridge the gap between traditional finance. So we have our financial advisors, we have our wealth managers, and the emerging fields of advanced technology. So machine learning and AI, decentralized finance, quantum computing, those are the key pillars of the Craft Center, of the research being done at the Craft Center. And you can see all of this work, what we've designed with the AMMs to do this automated rebalancing really came out of Craft-funded research. So this is really at the cutting edge of what's being done. We're developing the tools necessary to create the next generation of financial products and financial infrastructure. So kind of as a concluding statement, robo-advisors automated access to markets. What we are trying to do is automate how portfolios are designed, constructed, and maintained. So with that, I'm happy to take any questions you might have. Yeah, so this is fundamentally why there's this digital requirement. So current markets, kind of, as I said, based on like 1970s technology, are basically preventing AI agents from communicating with the market. If we go to a digitally native financial infrastructure. If we go to tokenization, which there are multiple experiments in tokenization happening now by NASDAQ, by BlackRock, by the DTCC, by a lot of institutions, once we have these digitally native assets and digitally native markets, we start to actually allow the AI to be able to directly interact. And that's one of the key things that is missing for kind of AI agents to be able to execute directly at the current moment. Yeah, so probably the most promising experiment in tokenization happening now is the DTCC, which is kind of the clearinghouse of all US financial markets. They kind of sit behind the entire financial system in the United States. And they got regulatory approval for a pilot of tokenization for highly liquid equities, ETFs, and other similar assets that they are running internally. So tokenization, this was approved as of, I want to say, either December or January. So while there's been talk about tokenization for over a decade now, where we talk about tokenized real world assets, it's finally actually starting to happen, at least in the United States, through programs like the DTCC. And as I mentioned before, NASDAQ is also similarly starting to tokenize the stocks that are traded there. These are being given conditional approval or no action letters by the SEC, the CFTC, kind of your alphabet soup of regulators are starting to actually look on tokenization as something that could be done rather as something to stop. If we go back to the Flash Question 2013, really the underlying technology of financial markets hasn't changed drastically. What's really changed is the speed that these can happen and what we can do about them. One thing that I will kind of bring up about the flash crash and what would happen if we had this AMM system sitting in the background is I mentioned this kind of rebalancing, where if the price externally moved and if our AMM copied that flash crash, you would see for that very short period of time, your portfolio would look really weird because you'd just be copying this external market. But then when the market rebounded 5 minutes later, all of a sudden you would also rebound. So if we're thinking about this as you're collecting a fraction of fees on every trade that's happening with your portfolio, this is actually a very good situation for you because you collected fees on the way down and you collected the fees on the way back up. So you started and ended at the same point, but you collected fees going in both directions. So while traditionally you'd say, oh, I sold on the way down and I bought back on the way up, and this is going to cost me a lot of money because I sold kind of in a panic, and then I had to buy back and I wasn't fast enough. Because this is an automated system and because it just follows this path independent curve, you're actually capturing these fees both directions. So it would work in both directions. Kind of two questions in there. The first one
There
about
was.
the circuit breakers. So like the market shut down for a time period whenever there's a large enough event. So those circuit breakers do exist. And ultimately, there's kind of two aspects that can happen. The flash crash was actually different than a traditional circuit breaker event. So like COVID, we saw the circuit breakers. During the flash crash, they actually reverted a lot of the transactions that occurred. So if you had sold on the way down and you thought you made a lot of money by buying back on the way up, those transactions were all canceled. And part of how they could do that is the T+1 settlement of current financial infrastructure, because none of those trades actually settle, actually are finalized until the next day. But kind of looking at the traditional kind of circuit breaker, which happened in March 2020, where we just had so much volatility that markets were crashing and they shut down for the first time is 5 minutes, then they do a 15-minute interval. And in those situations, if we have the AMM sitting on like DTCC tokenized assets, the AMM would also shut down during that period. So all of the rules of the market would still be followed. It's basically being run on the market infrastructure. It's just a different way of holding a position. Then on to the second question about the AI. While I'm saying kind of the market conditions, we have volatility, we have prices, I'm also including into that macro trends, news, information. I'm not saying that we should limit the information the AI is being given, but we do want to still make sure that it stays with reliable information, because we did see in past times, even humans falling for, I'm going to just say fake news. For instance, in, I believe it was 2013, there was a tweet that someone had hijacked had hacked the AP's Twitter account and had posted out that there was a terrorist attack. And the market moved quite significantly in the 4 minutes before that information was corrected. So yes, AI can fall for fake information, can kind of create more volatility by chasing these news feeds. But we find that actual human traders are doing the identical thing. So it's a give and take, and the main difference is the AI, we can put certain limits on. We could say, do not rebalance my portfolio by more than 0.5% in any given day. Which for a human, if they're kind of psychologically like invested in this, it's hard to maintain the rules that they want on their position. AMMs do exist in decentralized finance. So at present, they only exist for trading cryptocurrencies. But if you want to look up, the biggest kind of AMM company that exists is Uniswap, headquartered right across the river in Soho. And they're doing some really cool things with AMMs, really looking at them from the perspective of a market maker as opposed to the portfolio construction that we're looking at here. But there's a number of AMMs that exist for cryptocurrencies, but they don't yet exist for kind of real assets, going back to kind of that idea that we need tokenized assets to really implement the AMM logic. The dynamic weight AMMs, the way that we've been really working with these so far is based on the constant product design. So the utility function, where I was describing it in that one slide as the weighted sum of logarithms, because the log of a product equals the product, the sum of the logs. Ultimately, this is based on a constant product, or really the balancer geometric mean market maker formula. So really, the simplest dynamic weight AMM is just to make the weights of that geometric mean dynamic in time. But it's fundamentally comparable to the constant product design, just with dynamic weights to the geometric mean. But as you mentioned, there are trade-offs between kind of the arbitrage losses and the liquidity incentives. The more the market incentives exist for someone to come in to rebalance you, the quicker that's going to happen. So this is exactly the question that we were asking with the scalability, is how do we actually maintain this trade-off in a meaningful way so that we really get the frequent rebalancing that we want without sacrificing too much funds for the rebalancing strategy. Then your next question comes in about how we can actually protect the user from AI hallucination and how we can maintain fiduciary considerations. And really, this is at the forefront of what's being done in AI by the banks, by robo-advisors, by researchers. There's no one way to do this. Ultimately, this is an active research area to really enforce. So I don't want to speculate what the best way to implement these safeguards because it's an important future direction that we're working on. Then in terms of what was the next question that you had? The scalability. So again, this goes back to those trade-offs between kind of the incentive structure and the funds. And really, this is an active research area. As I said, the scalability is an open question that we're looking into to see perhaps even the small portfolios, as long as if they get too far out of line, they'll still be rebalanced in a reasonable way. So now instead of just saying we're going to maintain that 60-40 portfolio, maybe so long as it's within a 62 to 58% equity position, no one's going to step in. The incentives aren't there. But if it goes outside of that range, the incentives get large enough for someone to push it back to the desired 60%. Then you had some questions about validating the investor state from behavioral data. Again, this is an active research area. This is, I'm not going to say that this is a solved problem, but it's very much, we've seen it with kind of big data when that was the term back in about 2010. We saw it really with marketing where we were able to really find examples that the advertising marketing parts on Google, on Target, on Walmart, really were able to track individual investor states in order to serve them the best ads. Then your next question was about the system behavior during extreme volatility. And again, this gets to the question of kind of this path independence of the AMM system. The AI, we need to just make sure it has certain rules so that it doesn't over correct. But the AMM system in the background, if it's a kind of mean reverting volatility, that's actually the best system for the best state for the AMM. Because remember, these were designed originally as market makers. So anytime that you're basically buying low and selling high is a great situation. And that's really what's happening in these kind of highly volatile states that we would find. Circuit breakers, on the other hand, and this is going to be, again, addressed in a later question, if there's a circuit breaker, if the system shuts down, then trading on the AMM, if it's being being implemented through the DTCC, will also be shut down. You don't want to have trading on one secondary market and not another, because that gets rid of the entire purpose of the circuit breaker in the first place. Then in terms of the performance against traditional quarterly rebalancing, once we add in fees, slippage, and arbitrage, in back testing that has been done as part of my research group, what we found when we compared the AMM performance for target weighted, so just constant weighted positions, versus what's found in mutual funds, what's found in the target weighted ETFs that do exist, we find that the tracking error of the AMM is significantly lower, while the Sharpe ratio is actually comparable or higher for the AMM. So this is without any kind of optimization. As long as there's even just a small amount of fees, we are able to maintain a better tracking error with a comparable Sharpe ratio on the position. And then kind of where tokenization sits into this, the reason for the tokenization, as I mentioned in some of the previous questions, is really so that the AI agent is able to natively communicate with the assets and with the market. Right now, we kind of just say that AI is able to interact, is able to act. But to really do that in practice, the AI needs to actually be able to be embedded in the system. And this is where tokenization really becomes so vital. And then the last point was about balancing personalization with system scalability. And that's absolutely the point. Right now with humans, we are stuck with kind of that 10 portfolio options that we have to choose between. Whereas with the truly automated system, we may not be able to go to true automation at this point where everyone gets a personalized position, but we could do it where instead of having 10 positions, we have 500 different positions, and the AI is shifting you between those in order to kind of balance the trade-offs between personalization and scalability. So this is, again, active research. We're trying to see how far we can push these things in order to understand where the system might be going. So this is really getting to the question of the cryptographic encryption or the encryption of different financial markets. And it really comes down to whether the cryptography being used is quantum proof or not. And what we're seeing is the financial system is really upgrading its infrastructure to quantum ready encryption ahead of the release of actual quantum computers. And this is not something that is unique to blockchain, that quantum computers would be threatening from a security perspective. The entire financial system relies on encryption. When you sign into your bank account on an app or online, or through an ATM, you are ultimately communicating with a centralized database, and all of this is being done in an encrypted way. So quantum computing can greatly enhance the financial system, but it's also a threat if the encryption is not improved to the point of being quantum ready. Absolutely. Like healthcare costs are part of the investor state. So for instance, if I'm going to the doctor frequently, maybe the system should know that I'm going to have higher healthcare costs and should adjust accordingly. This is really the idea of having a real financial advisor. If I had a actual financial advisor and I knew I had healthcare costs coming up, I might phone them up and make sure I have ready liquidity in order to pay those costs. So you mentioned this as a non-financial risk, but I actually would put this quite clearly classified as a financial risk as part of the investor state. I'd say one of the things that we find in terms of like robo-advising, kind of the promise of it is, yes, having an advanced AI agent might only be accessible to the wealthy, but the idea of the robo-advising in general is that you're kind of splitting the cost across a large user base. So rather than having a personalized agent solely for you, maybe this agent is trained on a larger class of people, of customers. So it's not 100% personalized, but maybe it's only 75% personalized, or maybe it's 25% personalized. Uh, but still, you're able to uh, get pieces of these agents even at a reasonable cost because of the scale. And that's really the reason that robo-advising, the promise of robo-advising is about using the scale in order to diffuse the costs widely. Essentially, the robo-agent uh, the AI agent could during the circuit breaker, figure out how it wants to rebalance. So it can take that time in order to actually come up with the appropriate response, uh, as opposed to chasing the market. Um, and if we're looking at kind of highly volatile assets versus low volatility assets, this really just comes down to what risk aversions you want, uh, and what your behavior really is. So the idea is really that the agent shouldn't necessarily care what kind of assets you're invested in, as long as it sits within the space that you want those positions to sit. This is kind of a two-stage problem. The first part, in terms of what I propose today, the AMMs aren't actually necessarily being implemented on crypto assets or crypto markets at all. They're really about implementing AMMs for traditional financial instruments. Um, but when we take a step back and we look at how AMMs exist now, where they are solely for crypto assets. Um, the fact that they are tightly linked means that there is more hedging that can be done, even just using traditional instruments to hedge your crypto instruments. Um, Essentially, the AMM as just a decentralized exchange doesn't really care what the macro environment is. It's both the cost of these instruments, the cost of these markets as market makers is that they are information agnostic, but it's also the promise of them that because they're information agnostic, they can't be tricked. They can't, they just exist. And so if correlations increase or decrease, there's nothing really else that can happen. Um, so that is all the questions that I was sent. If you have other questions, please feel free to send me an email. I'm happy to chat further. Thank you very much.